Statutory surplus, computation, pricing, and valuation. Part 2. Statutory liabilities, provision for reinsurance. Any transaction that affects the balance sheet, but not the income statement, is a direct charge or credit to surplus. For instance, an increase in the Schedule F provision for reinsurance does not flow through the income statement, but it increases liabilities on the balance sheet, thereby decreasing balance sheet surplus. The increase, or decrease, in the provision for reinsurance from the previous year to the current year is a direct charge, or credit, to surplus. Illustration. Suppose an insurer has a 50% pro rata reinsurance treaty with an authorized reinsurer. A loss occurs on March 1, and a direct case reserve of $200,000 is posted. On June 1, the loss is paid for $300,000. At year end, the reinsurance recovery has not been collected, and it is more than 90 days past due. The financial statement entries are: March 1, debit incurred losses, $200,000, direct loss on the income statement. Credit incurred losses, $100,000, reinsurance recoverable on the income statement. Credit case reserve, $200,000, direct loss on the balance sheet. Debit case reserve, $100,000, reinsurance recoverable on the balance sheet. June 1, debit incurred losses, $100,000, direct loss on the income statement. Credit incurred losses, $50,000, reinsurance recoverable, income statement. Debit case reserve, $200,000, direct loss, balance sheet. Credit case reserve, $100,000, reinsurance recoverable, balance sheet. Credit cash, $300,000, direct loss, balance sheet. Debit reinsurance recoverable, $150,000 on the balance sheet. December 31, credit provision for reinsurance of $30,000 on the balance sheet. Change in provision for reinsurance, $30,000, a direct charge to surplus. Unrealized capital gains. Unrealized capital gains are direct credits to surplus. Suppose that on December 31, 20X4, an insurer has $100 million of assets, $60 million of liabilities, and surplus of $40 million. The assets are 80% bonds and 20% common stock. In 20X5, the stocks increase in value to $30 million. The federal income tax rate is 35%. The 20X5 financial statement entries are: debit stocks, $10 million on the balance sheet. Credit deferred tax liability, $3.5 million on the balance sheet. Unrealized capital gains of $10 million, a direct credit to surplus. And change in deferred tax liability of $3.5 million, a direct charge to surplus. Audit premiums. We show the accounting entries for a $10,000 policy written on October 1, 20X3, with an estimated audit premium of $2,000. The estimated earned premium for the full policy term is $12,000, of which the 20X3 portion is $3,000. Estimates of audit premiums may be included as written premiums or as a separate adjustment to earned premium. The accounting entries on 12/31/20X3 are either written premium of $12,000 and unearned premium reserve of $9,000, or written premium of $10,000 and an unearned premium reserve of $7,000. Deferred policy acquisition cost and premium deficiency reserve. Suppose an insurer writes a block of policies with written premium of $100 on July 1, 20X4. Acquisition costs are $20 million and expected losses are $80 million. Investment income covers other expenses. GAAP recognizes the premium and the expenses over the term of the policy by setting up both an unearned premium reserve and a DPAC, deferred policy acquisition cost, asset, and amortizing them over the policy term. On December 31, the remaining unearned premium reserve is $50 million, and the remaining DPAC is $10 million, for a net reserve of $40 million. We show the GAAP and statutory accounting entries for two scenarios. If by December 31, 20X4, incurred losses are $45 million, and the insurer expects another $45 million of incurred losses in the next 6 months, the DPAC is reduced to $5 million, and expenses are debited by $5 million on the income statement. Statutory has no DPAC, so no accounting entries are needed. If by December 31, 20X4, incurred losses are $65 million, and the insurer expects another $45 million of incurred losses in the next 6 months, the DPAC is reduced to 0, and a premium deficiency reserve of $15 million is set up on both GAAP and statutory statements. Interest due and accrued. Suppose an insurer buys $100 million of investment-grade 6% coupon bonds on March 1, 20X4, and classifies them as available for sale, FAS 115. By December 31, 20X4, interest rates have declined, and the market value of the bonds is $102 million. In 20X5, the issuer fails to pay the August 31 coupon, and the bonds are downgraded to Class 4. On December 31, 20X5, the market value of the bonds is $90 million. The August 31 coupon is still not paid, but the company expects to collect it next month. We show the accounting entries. 20X4. The cash received of $3 million and the accrued interest of $2 million are revenues or credits on the income statement and debits to cash and to interest receivable on the balance sheet. On the GAAP balance sheet, the bonds are marked to market, $102 million. The $2 million increase is a direct credit to equity. It does not flow through the income statement. On the statutory balance sheet, the bonds remain at amortized cost of $100 million. 2000X5. The cash received on February 28 of $3 million and the accrued interest of negative $2 million are revenues on the income statement and debits to cash and interest receivable on the balance sheet. By year end, the bond has been downgraded to Class 4, and it is shown at market value on both GAAP and statutory financial statements. GAAP shows a $12 million charge to equity, and statutory accounting shows a $10 million charge to surplus. GAAP shows $3 million as interest receivable and $2 million as interest due and accrued. The full $5 million flows through the income statement. Statutory accounting does not admit any of the interest, since the payments are more than 90 days past due. Method 1 shows no balance sheet or income statement entries. Method 2 shows the same entries as GAAP and then classifies the assets as non-admitted and has a $5 million direct charge to surplus. Real estate. On December 31, 20X4, an insurer buys a shopping mall for $50 million as a real estate investment. Rental income is $8 million a year, and depreciation is $2 million a year for 25 years. On December 31, 20X5, the market value of the mall has increased to $53 million. In 20X6, a competing shopping mall opens 4 miles away, and by December 31, 20X6, the market value of the insurer's shopping mall is $43 million. 2004, cash is credited $50 million, and investment real estate is debited $50 million. There is no change to surplus. 2005, rental income flows through the income statement at investment income, $8 million credit, and cash is debited $8 million. Depreciation expense is debited $2 million on the income statement, and investment real estate is credited at minus $2 million. No entry is made for the increase in market value. 2006. The rental income and depreciation entries are the same as for 2005. The book value of the real estate is $46 million, of which $3 million is not admitted, excess of book over market value, and there is a $3 million direct charge to surplus. Stockholder dividends and capital contributions. An insurer begins the year with $100 of 8% coupon bonds maturing on December 31 in 5 years. The tax rate is 35%, and taxes are paid when cash is received. The insurer remits the after-tax investment income to its shareholders. On December 31, the insurer sells an additional 1 million shares of common stock, with a par value of $1 per share and a sale price of $1.50 per share. We show the accounting entries. On June 30, the insurer receives $4 million of bond interest. $4 million times 35% equals $1.4 million paid to the Treasury, and $2.6 million are shareholder dividends. The same transactions occur on December 31. The accounting entries on each date are: debit cash $4 million on the balance sheet, credit investment income $4 million in the income statement, credit cash $1.4 million on the balance sheet, debit tax liability $1.4 million on the income statement, credit cash $2.46 million on the balance sheet, shareholder dividend $2.6 million, a direct charge to surplus. The accounting entries for the common stock issue are: debit cash $1.5 million on the balance sheet, credit common capital stock $1 million for par value of common stock on the balance sheet, credit paid in and contributed surplus $0.5 million for excess of sale price over par value on the balance sheet, direct credits to surplus $1 million for capital paid in and $0.5 million for surplus paid in. A misconception that is sometimes heard in actuarial circles runs as follows. For statutory accounting purposes, we must understand the computation of statutory surplus. In some states, we might need surplus amounts for rate filings as well. For actuarial pricing of insurance products, however, we may dispense with statutory numbers. We seek a return on the economic capital needed to support the insurance operations. We determine this capital by actuarial techniques such as probabilities of ruin or expected policyholder deficits. Many years ago, actuaries priced products to achieve a preset underwriting profit margin, such as 5% for most lines or 2.5% for workers' compensation. This pricing technique did not allow a comparison of insurance profitability with profitability in other industries. An early attempt by Arthur D. Little to examine insurance profitability looked at the return on assets, ROA, or the income during the year divided by the assets held by the insurance company. The return on assets supposedly shows how efficiently insurers are using their assets to produce insurance policies, just as the ROA for an auto manufacturer shows how efficiently it uses its assets to produce automobiles. But insurers do not use their assets to produce insurance policies. An insurer might invest its money in the bonds issued by an automobile manufacturer. The assets represented by these bonds are used to manufacture automobiles, not automobile insurance policies. Some financial analysts apply return on equity measures to insurance, looking at the ratio of GAAP income to GAAP equity. Ferrari, 1967, examines the calendar year profitability of the insurance industry. Pricing actuaries, concerned with prospective rate making, look at benchmark equity or benchmark surplus, the equity or surplus needed to support the insurance operations, not the equity or surplus currently held by the company or by the industry. In other industries, the return on equity is a proxy for the return on invested capital. For property casualty insurance, GAAP equity is not the same as invested capital. Invested capital is statutory surplus plus the capital embedded in gross unearned premium reserve and full value loss reserves. The invested capital implied by statutory surplus is the crux of financial pricing and valuation. Double taxation. The valuation of an insurance company requires an adjustment for the cost of holding capital. The cost of holding capital is at least the cost of double taxation. Myers and Cohn, 1987. And perhaps as high as the difference between the cost of equity capital and the after-tax investment yield. Atkinson and Dallas, 2000. Suppose investors must contribute $100 million to support the writing of insurance policies. and this capital is invested in 10% coupon taxable bonds. If they invest the capital themselves, the investors pay personal income taxes on the $10 million return. If the insurer makes the same investment, it pays $3.5 million of corporate income taxes and remits the remaining investment income to the investors, who pay personal income taxes on this dividend. The cost of double taxation is the difference in the taxes incurred between direct and indirect investment of capital. The taxes paid on direct investment of capital equals the investment yield times the personal tax rate. The taxes paid on investment of capital through an insurance company equals the investment yield times the corporate tax rate plus the quantity 1 minus the corporate tax rate times the personal tax rate. The difference between these two is investment yield times the quantity corporate tax rate plus quantity 1 minus the corporate tax rate times the personal tax rate minus the personal tax rate quantity, which equals investment yield times the corporate tax rate times 1 minus the personal tax rate. If the investment yield is 10% and the corporate tax rate is 35%, and the average personal tax rate is 30%, the cost of holding capital is 10% times 35% plus 1 minus 35% times 30% minus 30%, which equals 10% times 30% times the quantity 1 minus 30%, which equals 2.45%. The investors pay an additional 2.45% of the yield on their capital to the taxing authorities. This is the after-tax loss to the investors. The loss before personal income taxes is the investment yield times the corporate tax rate, or 10% times 35%, which equals 3.5%. To induce investors to fund the insurance operations, the 3.5% of lost yield must be paid by the policyholders, not the investors. If the policyholders pay this money directly to the investors, this would be the full cost of holding capital. But there are no direct transactions between policyholders and investors. The policyholders pay this money as part of the policy premium, and the insurer remits the money to the investors. This introduces another layer of tax, since the policy premium is pre-tax and the compensation to the investors is post-tax. The needed margin is the policy premium, as a percentage of the investment yield on investor-supplied capital is investment yield times the corporate tax rate over 1 minus the corporate tax rate, which equals the investment yield times 35% over 1 minus 35%, which equals the investment yield times 53.85%. The double taxation affects invested capital, whereas the money paid by policyholders is a margin on premium. The needed margin is capital times investment yield times 53.85% divided by premium. If the premium is paid at policy inception, and the taxes are paid on average at mid-year, the needed margin is capital times investment yield times 53.85% divided by the quantity premium times the 1 plus the investment yield to the 1/2 power. Atkinson and Dallas, 2000, define the cost of holding capital as the difference between the cost of equity capital and the after-tax investment yield of the insurance company. To illustrate, suppose the cost of equity capital is 12% per annum, but the insurance enterprise invests in 8% Treasury securities. The cost of double taxation is 35% times 8%, which equals 2.8%. The additional cost stemming from the conservative investments of the insurance company is 12% minus 8%, which equals 4%. And the total cost of holding capital is 2.8% plus 4%, which equals 6.8%. This is the amount that policyholders must pay to the investors to induce them to fund the insurance operations. Since the policyholders pay this money indirectly through the profit margin in the premium, which is taxed as underwriting income, the additional premium is 6.8% over 1 minus 35%, which equals 10.46%. If the premium is paid at policy inception and the taxes are paid on average at mid-year, the profit margin is 10.46% over the square root of 1.08, which equals 10.07%. This implies that with an 8% investment yield and a 400 basis point spread between the target return on capital and the investment yield, the policyholders pay 10% of investor-supplied capital to compensate for the indirect investment of their funds. The needed underwriting profit margin to be combined with expenses and discounted losses is 10% divided by the premium to capital ratio. If discounted losses and fixed expenses are $2,800, the variable expense ratio is 22%, and the premium to capital ratio is 1.25, the needed underwriting profit margin is 10 divided by 1.2, which equals 8%. And the indicated premium is 2,800 divided by the quantity 1 minus 22% minus 8% quantity, which equals 4,000. The cost of holding capital depends on both the capital explicitly held as surplus and the capital embedded in statutory reserves. We illustrate the cost of double taxation both with and without consideration of deferred tax assets. An insurer operates at a 2-to-1 premium to surplus ratio. Each year, written premium is $200 million. The unearned premium reserve is $100 million. The prepaid acquisition expense ratio is 25% of written premium, and the undiscounted loss reserves are $300 million. The risk-free interest rate is 5% per annum, and the company's investment yield is 8% per annum. The IRS loss reserve discount factor is 80% for all years and all valuation dates, and the tax basis reserves are at fair value. And 25% of held reserves are paid out during the next year. If deferred tax assets are not considered, the invested capital is $100 million of surplus plus 25% times $100 million, which equals $25 million of equity in the unearned premium reserve, plus 1 minus 80% times $300 million, which equals $60 million in the undiscounted loss reserves, for a total of $185 million. The cost of double taxation using the Myers theorem is $185 million times 5% times 35%, which equals $3.24 million. The cost of double taxation using the company's investment yield is $185 million times 8% times 35%, which equals $5.18 million. The Atkinson and Dallas cost of holding capital is $185 million times 6.8%, which equals $12.58 million. The statutory deferred tax asset stemming from revenue offset is 35% times 20% times the unearned premium reserve, which equals 35% times 20% times $100 million, or $7 million. The statutory deferred tax asset stemming from loss reserve discounting is 35% times the reserve discount that is expected to reverse in the next 12 months, or 35% times 25% times 20% times $300 million, which equals $5.25 million. The invested capital is $185 million minus $7 million minus $5.25 million, which equals $172.75 million. The cost of double taxation using the Myers theorem is $172.75 million times 5% times 35%, which equals $3.02 million. The cost of double taxation using the investment yield of the company is $172.75 million times 8% times 35%, which equals $4.84 million. The Atkinson and Dallas cost of holding capital is $172.75 million times 6.8%, which equals $11.75 million. Valuation. Cost of holding capital. We continue the illustration to show the valuation of the company. The insurer has $100 million of surplus, of which $12.25 million are deferred tax assets. $200 million of written premium each year, $100 million of unearned premium reserves, and $300 million of undiscounted loss reserves. The cost of equity capital is 12% per annum, and the tax rate is 35%. The prepaid acquisition expense ratio is 25% of written premium, and the discount factor for loss reserves is 80%. After-tax net income is remitted to shareholders. The invested capital is $100 million, surplus, plus 25% times $200 million, the equity in the unearned premium reserve, plus 20% times $300, equity in undiscounted loss reserves, minus 12.25, the deferred tax asset, which equals $172.75 million. If the insurer expects to earn $36 million of pre-tax income each year, the after-tax net income is $36 million times 1 minus 35%, which equals $23.4 million. The present value of the future net income is $23.4 million divided by 12%, which equals $195 million. The company is profitable. Its net worth is $195 million. If the insurer expects to earn $30 million of pre-tax income each year, the after-tax net income is $30 million times 1 minus 35%, which equals $19.5 million. The present value of the future net income is $19.5 million divided by 12%, which equals $162.5 million. The company is not profitable. The shareholders would gain by liquidating the company and taking the $172.75 million. If the costs of liquidation are more than $172.75 minus $162.5, which equals $10.25 million, the company should continue operating. Statutory surplus and GAAP equity of property casualty insurance companies differ from invested capital. For pricing insurance products or valuing an insurance company, actuaries must be careful to include all capital in their analyses. This requires a complete understanding of statutory accounting, with particular emphasis on direct charges and credits to surplus.